YouTube, it's Tracy from Entrepreneur Girl, and today is Thursday, and we're going to do the next in our stock trading video series. If you've missed the other ones, you can click on the link below, and it'll take you to the whole playlist, so no worries there. But today we are going to be kicking it up a notch. We're no longer talking about the mindset of the stock market. We're not talking about some of the technical analysis. Now we're actually getting into market mechanics, and we're going to be talking about the cycles. As promised last time, I told you to eat your Wheaties because we are finally hitting the hard stuff with stock trading. And today's not bad, so I don't want to scare you off, but we are going to be talking about some terminology that you're not familiar with, and it might feel, just a little overwhelming, but we're going to take it in very small, bite-sized chunks. Now, before, we've talked about that we're not going to expect 100% of all of our stocks to be wins. I mean, it's actually been quoted that most of the gurus in the stock trading field consider 7 out of 10 wins doing really well. Already familiar with cycles. It's pretty much how the universe operates, right? The planets orbit the sun, and that equals a year. Other pattern cycles equal to 4 seasons. Part of an industrialized economy also has a lifespan. Introduction, growth, maturity, decline. And because as people, as humans, we anticipate and we actively look for these cycles, stock market cycle tends to lead the business cycle by about 3 to 6 months. And you'll see what I mean when we start looking at charts. When you look at a chart, you can actually physically see cycles, especially if you're looking at a chart that's over the course of several years. If you're looking at a monthly or a weekly chart, you can still see it because you can see the bell curve that I've shown you in the past. And that bell curve actually a cycle formation. This happens on a micro and a macro level. Each large cycle is made up of a bunch of smaller cycles. Even the smaller cycles is segmented into a bunch of even smaller cycles. I like to think of this, a real easy analogy would be a book. When you look at the whole book as a whole, that would be the stock market. But within the book, we see that we have a bunch of different chapters. Those are the big cycles of the book. And then within each chapter, you can see that there are many sections or headers. And each header is made up of many paragraphs. Many paragraphs is made up of many sentences. Even every sentence is made up of many words, and even the many words is made up of many letters. So that's kind of how you can look at it. You think you're looking at the big picture, but really the big picture can be divided in smaller and smaller and smaller and smaller and smaller parts. Depending on the chart that you're looking at, it's giving you a snapshot, it's giving you a picture of that particular time frame. Cycle charts can be found monthly, weekly, daily, or one bar or one candlestick, which we're going to talk about next week, indicates a particular time frame. So now we're going to talk about the 4 stages of a cycle. So here we have a bell curve, and this is going to show us close up of all 4 movements of a typical stock. And so what we're looking at now is stage 1. And stage 1 has this sideways momentum, and the industry calls this basing. And the reason they call this basing is because it's forming a new price frame, right? It's going to move off of it sooner or later, and it's going to start to rise again. But right now it's forming its base. This is going to be the base from which it pushes off of in order to start to increase and, make that rise. And the mindset of this stage, which is really important that you remember the mindset because it kind of makes sense when you think about it, is indecision. And the reason this is such an indecisive area is because the stock is low. The price is low. This is the valley. It could take weeks to months to get out of this, right? And the bottom buyers are buying them, and then the sellers are pushing it back down. So there's kind of this equal pressure on both sides between the buyers and the sellers, and that is what is making it move sideways. The next stage is going to be stage 2, and this is where it's making an upward move. Okay, stage 2 happens when the price breaks out finally and it starts to shoot into an uptrend. And the mindset of this phase, which is important to remember, is optimism. people are really optimistic about the stock now, and that's formulating greed. And then this greed equals this drive upward that we see. A lot of people refer to this stage as the markup stage. That's because you're seeing this kind of rise, fall, rise, fall, rise, fall happen. This is as people are figuring out and establishing the price. They're trying to see if it's at its peak, and they're going to refuse to pay higher prices, or if they think it's going to continue to go upward and increase, and so they're buying more of it. And so there's this kind of battle happening, but the curve overall is an upward trend. And then we get to stage 3, and that happens when there's this ceiling that we hit, and it's starting to slow down. Growth is starting to slow down and come to a halt. And stage 3, called the distribution stage, very unpredictable what is going to happen in this stage, because there's a lot of up and down movement happening. There's like this emotional tug of war going on between buyers and sellers. This kind of makes it crazy. And then what happens is when the large institutes decide the stock has run its course, they dump it, which, is they distribute it. They push it even lower, which brings fear. And then fear, of course, brings an even lower price. And eventually, this descent spirals down and then eventually slows down until it kind of levels out here. And then finally, we have stage 4 way down here. And stage 4 is just really frustrating. A lot of frustrated investors are here. They're watching their stocks tank, their principal shrink. So when this stage happens, you're better off to stand on the sidelines. Then when the selling is all over, it's all calm, you can step in and buy high quality bargains that are ready to recover, because eventually this levels off and heads back to this basing stage 1, where it's setting the foundation to increase again. And this is where you want to be monitoring it. This is where you want to live. And then this is where you want to be on the sidelines, is this downward trend. The cool thing is that the more that you practice looking at these charts, you're able to actually see which stage of the cycle that particular stock is in. And different stages call for different reactions. In stage 1, we are scanning for stocks that are in stage. We monitor those stocks, and when they start to break out and shoot upward, if it meets our other criteria, we buy. Stage 2, where you will spend most of your time and most of your money. This is where you buy your stocks and then ride them for as long as you can. Stage 3, where you kind of stand on the sidelines because it's unpredictable, because it's crazy and risky, just because it's so unpredictable and volatile. And then finally, stage 4, where you avoid trading altogether unless you are selling shorts, which we will talk about in the next video. Now, what I thought was really, really cool, kind of an interesting side note, that as a general rule, stocks fall 3 times faster than they rise. Why is that? Well, fear is stronger than greed. But you probably already know that because it feels stronger too. So now we are going to talk about supply and demand. And here in stage 4, as everything comes to almost a near stop, demand will shrink, will go down, and supply will be way up. And that is because no one wants the product, and so there's a lot of product out there for people to buy up. But there's less buying up because there's less demand. Eventually, however, following the blue line, we do make our way back to stage 1, sometimes over the next weeks or months or maybe even years. We get to stage 1 where the stock is starting to form its basis again and is going to start increasing and rising. So stage 1 is filled with this indecision here, but as it starts to break out of its ceiling and head up and the price increases, you will see that this greed takes over, makes people hungry, and they demand the product. So the demand is up, which means the value goes up, and it means the supply then goes down. So it kind of goes up and maxes out and starts to stall out here at the top, and then we start to fall back down into stage 3, which again is filled with indecision, comes back again, which leads to fear, and when people are fearful, they start to sell the product. So they decide they don't want it, they get fearful, and then we have a lowering of price, a lot of supply, and a very low demand. And this is how supply and demand works, and you can kind of see how it exactly correlates to stage 1, stage 2, stage 3, and stage 4 of our cycle that we're talking about. Okay, so I just randomly picked a stock chart to show you, and I picked Ford Motor Company because most of you are familiar with that, right? So I looked up F stock chart. The F is the stock symbol. The symbol is just an abbreviation for the name. So F being for the Ford. And that's how it works. You'll get familiar with the symbols. You have to look up the symbols if you don't know and you want to look up a particular company. So here we have Ford, and this is the chart that we've been talking about. There is the 1 day, the 5 day, the 1 month, 3 month, 1 year, 5 year, and max that we talked about. This right here picture is the max, so that you can see overall. I wanted you to be able to see the general trend. Here we are at stage 1, right? We're at the base, and we're kind of moving this sideways momentum. And then all of a sudden, we start this upward trend into stage 2. Now, as you also see, stage 2 just doesn't shoot straight up. It has a bunch of ups and downs, ups and downs, ups and downs, but it's making this slow trend upward. It's not always slow. Sometimes it's fast, as you'll see here. See, it went spiked up, and sometimes this could be on a news story or something happens within the company, but it spikes up, and then this is where people are trying to decide whether they're in stage 3 or not. When has it maxed? When are we starting to hit stage 3? So you start to kind of level off and make this sideways movement as people determine if it's just a little lull in the activity and it's going to continue upward, or like this, there was a lull in the activity but it trended upward, or if this is going to be the big downward spiral, and then it recovers a little bit but continues to fall until we reach our low point, which look is almost equivalent to our base. We have our stage 4 right here, November 21st, 2008. And then when we really start to bust out of that is May 29th, 2009. So November 2008, so we're looking at 7 months later. It took 7 months for it to re-enter into stage 1 and start to make its stage 2 appearance. And here we go. So you can see the cycles happening, and we talked about this on the macro level, that you can see the trend. You see it going up, peaking, and you see it going back down to where it started. If we start to look at some of these smaller ones, though, you can start to see the smaller trends in and of each one of these. You can see it going sideways like stage 1, then it busts out, has this upward trend. So we start to make a sideward stage again. We've ceilinged out, and now we're entering stage 3. As we go down, we'll almost level again with stage 1, and that is our stage 4. And then we are still here. We start to go up again. We hit the ceiling again into stage 3, where we dive back down, and then we'll regroup and enter back into stage 1. So you can see these on every level, even the 1 day levels. So here we are at 1 day, and this is how our day started. and we're kind of duking it out, making this sidewards movement, even though it's not level. And then all of a sudden we break out of the ceiling. See the ceiling there? We're capping out there, we're capping out there, we're capping out there, and this is all like a straight line across. That's our ceiling. And then once we bust out of that, now we're making all this movement up. So the bell closes at 4. And this is what it looks like. Okay, so one final thing, and then I will leave you to digest everything we talked about, is support and resistance, or also called action and reaction. And understanding all of these things that we talked about today really does put you at an enormous advantage to make, really good decisions and to make, really profitable decisions. Many people don't take the time to learn this stuff, and then when they fail, they say, oh, that's like gambling. When it's really not. There's a whole science behind this. There's a whole educational process that happens that you can, make educated decisions if you take the time to learn. So you learning what we've done just today, we haven't even hit the rest of the series, just today really does put you at an advantage. So there's lots of trading tools. Some of them you can trade just fine without, others you can't, but no one tries to trade without this support and resistance. So listen up, because it's pretty important. It's simple and easy, but it underlies all the market moves, and that makes it really important. Okay, so now I'm going to attempt to draw for you. And this is a house, and you are on the bottom floor of the house. So you're standing here in the living room on the house on the first floor, and in your hands you hold a ball. And the ball equals the price of the stock. You toss the ball over your head. It soars upward and hits the ceiling. The ceiling keeps it from rising further, keeps it from rising any higher. So this ceiling equals resistance. Now the ball falls back down and it bounces off the floor. So the floor then stops it from falling further and offers it support. So the floor equals support. Next, you spot this hole in the ceiling. You throw the ball as hard as you can, and it flies through the hole and hits the ceiling of the second story. The ceiling again equals resistance. Then the ball falls to bounce on the second story floor, which now forms the support. So understand that the first story ceiling, this R that used to be, is now the S. It's now the support. This is kind of a silly example, but I hope that it illustrates support and resistance, because you'll see that support and resistance, buying and selling pressure, form on every single time frame from minutes to years on every single chart that you're going to see. As you study this support and resistance, you have to remember that they are price areas or price zones. And you can see like the zone, the red being the top and the green. And this is the zone that the price is in currently. And you'll have a little bit of leeway, but it's going to stay within this zone. Much like jumping on a trampoline, the trampoline supports you when you land on it, but the depth of your bounce, will vary a little bit each time. So it's not going to stay level throughout time. Now picture it when you're looking at the graphs. You can picture that resistance equals a buyer who jams their hands in their pockets and refuses to pay a higher price for the stock. Now say the stock shoots through the resistance like it did here, and the price will continue to rocket for a little bit, maybe hours, maybe days, until some new factor will suppress it. And when it sells off, that pivot point, being right here, will create a fresh resistance. Then the stock will fall back to the earlier resistance area, which is now the floor or the support. and it will stay there until buyers absorb the supply and in so doing support it. That was the last thing we had to cover today, so I will see you next video when we talk about selling shorts. Well guys, I hope that video was a little helpful to you in your stock marketing understanding and journey with me. So I know it's a little confusing, we're starting to learn about candlesticks and graphs and what it all means and supply and demand, and it gets a little bit more complicated, but this is how we're going to do it. We're going to take it just a little bit at a time, and then when we put it together, it over and over and over again, it will start to make sense. So by the time we get to the last video in the series, hopefully everything will just be clicking and you'll be understanding it, because you'll be hearing the same things over and over and over again. You won't just have to, kind of figure it out based on any one particular video. So I would love to hear your experiences and what you've been doing so far. Just go ahead and comment down below and let me know, and I will talk to you guys next video. Bye.